And welcome to Intermediate Investing, a commonalized approach to evaluating assets. So the reason we're putting this video out is because a lot of people sort of say there can't be any earthly way of comparing physical property investment, which you would typically value on a value per square foot or a yield, with an equity which would be typically valued on a PE or a PEG basis, or a net asset value, and a bond obviously of yield to maturity and price. Versus a long-term private equity opportunity. But we believe there is actually a way to evaluate assets on a commonalized basis, and not only is there a way, it's actually critical to form a fairly, let's call it, mechanical approach to how one compares assets. In our world, we use what's commonly referred to as the internal rate of return, or IRR, and on this next slide you'll see a few sort of definitions from Wikipedia, also referred to as the economic rate of return, or the discounted cash flow rate of return. It's obviously quite closely linked to the so-called net present value formula. We're not going to go through all of the technical stuff here, but I think the important thing, if you look at the next slide, is how it's actually calculated. And it's not important necessarily for the purposes of this video to understand this from a technical point of view, but really all the internal rate of return does is it looks at an investment as a series of cash flows, and it calculates what the return is inside of that investment opportunity over the life of the investment. And the formula is shown here, and really what this formula really says is that where your net present value is zero, you're really just discounting a series of cash flows over a period of time. Yeah, and it's really just taking a cash flow, taking the net present value and plugging that as zero, and looking at what the return will be over that life. So having a look at a very simple example, you buy a share or an equity today for 100, you get a dividend yield of 4% for 4 years. In your 5th year you sell it for 200, so you've doubled your money, but you don't collect the dividend in that year, just in this scenario. It's so important to remember that your cash flow signs must be correct. So looking at this example, on the next slide you'll see that on period 0, which is today, you have cash flow of minus 100. Then over the next 4 years you have a positive cash flow of 4, which is the dividend yield, and then in year 5, as I said, you're not collecting the dividend, but you're selling it for 200, and the IRR is calculated at 17.5. And then just going back to illustrate the theory, you've got net present value discounted of those cash flows, discounted by the IRR, and you can see today's 100 cash out has no time value impact because there is no time. But when you look at year 4, for example, that dividend of 4 that you receive will actually only be worth 210 when discounted at 17.5%. And really what you can see there is that the sum of those discounted cash flows also translates into zero. All right, so what? The IRR, we believe, allows you to compare seemingly incomparable assets, because really all it does is it breaks every investment, regardless of its form, down into a series of cash flows. For example, if you were to invest in a private equity opportunity where you invest today, you get no cash flow, and then after 6 years maybe they do start returning cash. Same principle, you would have cash out today, no cash flow for say 5 years, and then fairly lumpy cash flow returns. It's very different obviously to the way the cash flow would look for say a fixed deposit. So breaking every investment down into a series of cash flows allows one to compare a 5-year bond with a 5-year equity opportunity with say a 5-year fixed property investment. But obviously critically important still, unfortunately, is one has to make some sort of assumption about the value at which you're going to sell the asset, and that in itself, that exercise in itself, is actually very, very useful. Right, so in this next slide we're going to start comparing the investment merits of 3 different investments. The first option is a simple 5-year fixed deposit that's going to yield you 7%. The second one is a 5-year equity investment that's going to pay you an initial dividend yield of 3%, but it's going to escalate quite nicely. And at the end of 5 years, you're going to sell that for 200. And then the third option in this scenario is a property investment, a direct property investment, which offers an initial yield of 7%, and after 5 years, you will sell that for 65% gain, which is 165. And we're not going to spend too much time, but just to illustrate the principle, all three options, the fixed deposit, the equity, and the property, all have an initial cash flow of minus 100. The fixed deposit pays you 7% consistently over the period. The equity gives you a dividend yield of 3, escalating quite nicely. Property pays an initial yield of 7, also increasing quite nicely. And then at the end of the 5-year period, one gets your capital together with the last year's interest back. The equity, you get your dividend together with the 200 sale proceeds, and then you get 165 back, being the sale proceeds. And there you can see the IRRs calculated on the fixed deposit. It's very simple. It's really just the interest rate, which is 7%. The equity gives you an IRR of 17.9, closely followed by the property investment, which in this scenario yielded a 16% return over the period. Okay, so again, the question is, why even bother with this? We believe that it allows you to compare seemingly incomparable assets, because you really break it down into a commonalized approach. It ensures that all assets are evaluated free of prejudice, free of sort of likes or dislikes. Every investment is evaluated objectively on its cash flow merits. We believe it helps you keep focused on generating returns systematically over a period of time, and breaking every investment down into a logical time frame. And also, very, very importantly, we believe is very simply the discipline of comparing assets on similar time frames and then playing around with different time horizons, because that often does generate quite different returns over time. We believe it helps you understand how returns are generated over time, and there's almost an optimal holding period. And again, that flexibility is very, very useful. We believe that it really contributes meaningfully to effective asset allocation, but most importantly, we feel it helps one to decide when assets are correctly priced, because clearly if you feel an equity, for example, you're going to pay 100 for it today and you're going to sell it at 125 5 years from now, clearly your entry price of 100 would be incorrect. All right, just a couple of practicalities with IRR. You obviously need to make a whole lot of assumptions, and unfortunately that's always part of the investment life. And this, however, if you apply careful thought and you look at history and you're fairly clinical about it, needn't be sort of a wildly unpredictable exercise. We also believe that one needs to play around with holding periods. So you might start out taking an initial 3-year view on an equity and trying to compare that to a bond and a listed property investment. But suddenly you realize that, by extending that from 3 to 4 or 5 years, it introduces a lot of flexibility. So one needs to keep a fairly open mind as you go through these exercises. I think wrestling with different assumptions and different holding periods really is very effective in the asset allocation, the asset selection process. And then bottom line is, IRR is very, very useful in long-term asset allocation and helps very much through that sort of mechanical approach with deciding where value is in the underlying assets. And then, how to do IRR calculations. Doing them manually is a really time-consuming and a complex process. But fortunately, financial calculators, whether it's an HP business calculator or a Texas Instruments, all of them have got very, very worthwhile IRR calculation functions. But also Excel and other spreadsheets have got wonderful IRR tools. So hopefully this has helped to explain a little bit how effective IRR calculations are in actually determining and comparing different investment opportunities. In closing, we'd urge you to watch some of the other videos in this section for context, but remind you that this video and all of them in the series, frankly, are really just for instructional, educational purposes and shouldn't be seen as financial advice. And in closing, just to remind you that this video and the entire series series is brought to you by Kerner Perspective and KP Fiduciary Solutions, and you can watch all our other videos on our YouTube channel, which is Kerner Perspective, and that's with a K. Thank you for watching.